asset price inflations don't go on forever. By their nature, they come to an end. You know, asset price inflations come to an end for a number of reasons. They can come to an end because eventually the central bank is forced by concerns about either excess speculation or actual consumer price inflation to raise interest rates, and that brings a party to an end. Or they come to an end, asset price inflations come to an end because the outside world frankly becomes so bad that even the rose-coloured spectacles that the irrationally exuberant investors are wearing splinters. And you know, I like to go back to maybe one of the most under-recorded and yet one of the most important asset price inflations, I think, in modern history. And that's what happened in the United States between 1935, 36, 37. You know, to listen to the Yellen and Bernanke, you would think that QE policies were a grand new experiment that has never happened before in modern times. But in fact, the Federal Reserve from 34 to 36, although they didn't call it QE, actually ran a QE policy. If you look at the expansion of the Federal Reserve balance sheet between 1934 and 36 as a percentage of GDP, it's pretty well the same as what happened from 2009 to 2012. It didn't happen because the Federal Reserve at the time decided in favour of QE. It happened because the dollar was devalued in 1934. There were huge gold inflows to the United States, and just according to the logic of the time, the gold inflows were monetized. Now, so you had 2 or 3 years of zero interest rates, bond market manipulation effectively, very strong stock market. So I think the stock market and commodity markets, today you would call it asset price inflation, rose tremendously through the years 35 to 1936. But there were some nasty things happening in the background. By the time you get into end 36, early 37, the US economy had, the recovery was tending to slow up. There was tremendous geopolitical risk growing with Nazi Germany in Europe, Imperial Japan in the Far East. And a lot of domestic political concerns too with the Roosevelt administration and Labour legislation and everything else. So the outside world became so much worse that the spectacles began to splinter. And what you find, and on top of everything else, the Fed got very worried by early 1937 about excess speculation, and there was a lot of talk about Fed tightening policy, and bond yields began to rise, a bit like what's been happening in the last 6 months. And so between June and October 1937, the stock market suddenly dives, collapses by 40%. It's one of the biggest crashes in the US stock market history. And the recession, which accompanied that, 37 to 38, was called the Roosevelt recession, and was more severe than the 1930 recession. So that's an extreme example of asset price inflation coming to an end, burning itself out. Now to switch immediately to the opposite end of the spectrum to today, you've already seen some asset price inflation generated by the Bernanke Fed in a number of areas beginning to fade. You know, in the 2010-2011 period, there was a lot of asset price inflation in the emerging markets, anything to do with China, commodities, all went wild, a lot of speculative stories. But by the time we're all learning about how corrupt the Chinese system is and how it's really slowing down and all the flaws, it's too much for many investors to bear, and prices are falling, emerging market currencies in crisis, even without any rise in short-term interest. So that's a situation where asset price inflation is coming to an end in some areas due to the story just being too bad. But the more general point I'm coming on to here is that this asset price inflation that we've now got in the world, and maybe it's moved on to advanced equity markets, high yield credit markets, this will end at some point. And when it ends, and I think von Mises, of course, said you can't predict when these things are going to end, you can only have a sense of intuition when they're going to end. When it ends, which it will end, there's going to be another political cry. There's going to be some political. There's going to be a big political reverberations. You know, here's been this grand experiment run by the Fed. It's very likely will fail in terms of some crash and asset price deflation. What happens next? And I think that's the key. That's a political question. You know, there's two ways one can imagine the U.S. political pendulum going. It could go in the direction of, we've had this vast sort of managed experiment, regulation, money printing, everything else, it's failed. Let's get back to the fundamental values of the revolution in 1776, revamp competition, get back to free market, reform the constitution, everything else. You could see the political pendulum going in that direction. Or it could go in the opposite direction, towards an accelerated drive towards Hayek's road to circle. And I think it's very difficult to make that prediction. Hopefully it's going to be the first, which would involve deregulate, as part of the process, monetary stability and deregulating the financial system.
Brenda, can you not have asset prices without sort of it turning into a bubble? So I'm thinking particularly in markets, housing markets, where you have supply-demand imbalances, they can sustain a certain level of asset price inflation for a while, and maybe they come off a little bit, but they don't sort of, it doesn't deflate, and it just, the rate of growth just slows. I mean, isn't that not possible?
Well, you know, you're raising two very important points. Asset price inflation is not the same as a bubble. You know, asset price inflation is just, there's irrational exuberance, and you can talk about there being a speculative fever, and the temperature in the speculative fever is not always 100 degrees, which may be the bubble. You know, in some asset price inflations, it may only get up to 30 degrees or 40 degrees. So in different cycles, the asset price inflation reaches. Now, there will normally be one mark, even when the asset price inflation in general gets up to 40 degrees, there may be one small subsector where it gets up to 100%. So you could say during the asset price inflation of the 1980s, you actually got a bubble in golf club memberships in Japan. Or in this particular asset price inflation, you might say you actually got a mania or a bubble in bitcoins. I hope I'm not upsetting you and saying, you know, you may, or in the 17th, 18th century, I can't remember from my history when the tulip bubble mania was, but I would be pretty confident, and in fact there is some work to show this, that the tulip bubble mania was only part of a more general asset price inflation, but the actual mania was in one small segment, the tulip bubble. But the problem at the time was the Bank of Amsterdam or whatever was going into fractional reserve requirements, and you got this big increase in money supply. So, but the so I would say now can asset price inflation sometimes die out without there being a huge crisis? Yes, if an economic miracle comes along, and that you do get economic miracle. I mean, suppose for some reason none of us can think of here, productivity growth suddenly was to accelerate to 3 or 4% a year in Europe and the United States. Then maybe that would ratify these high level of asset prices. And the nearest example I can think of that situation is what happened in the early 1950s. You know, I mentioned earlier QE was not a new experiment. It happened in the 1930s. It also happened today, but it also happened in the late 1940s, early 1950s, with World War II financing and the growth of the Fed balance sheet. But the Fed exited from that with the Treasury Accord and freeing up interest rates in 53, 54 without there being any crisis. But that was an age of economic miracle. You had Japan growing at 10% per annum, Germany growing at 10% per annum, a productivity miracle. So yes, I mean, there are exits possible, but you have to be very, very lucky.
Yeah. I would like to go back to the title of this conference, and especially the second half, the implications of bailouts, the consequences, and especially the political consequences. I would like to know whether the model of the welfare state can survive in those conditions. It's a question for both of you.
You probably have a better answer to it than I do.
Whether the welfare state can survive.
Yeah.
I don't sort of have a grand answer to that, but it's sort of is linked to, I suppose, coming back to the question as to why central bankers excused their mistakes in monetary policy. Why, and part of that being the deal that essentially Obama or the European equivalents want the central banker to finance their deficits through money printing or keeping bond prices up. So that part of the deal is we'll agree with you about not being so rigorous in monetary stability, but you certainly have to try to keep our government costs down. Now, is there, if we get away from that sort of rigged system where the central bank is manipulating the long-term rates and keeping government funding costs cheap, does that mean the welfare state would have to be, the entitlement state, let's say, has to be cut back much sooner than it would be otherwise? And I think the answer to that is yes. I mean, if it's not Mr. Bernanke or Mr. Draghi or whatever providing backstop finance at very manipulated low rates, then the political process will sooner come to do something about an unaffordable entitlement state. And if the banks are not given regulatory forbearance anymore and a whole lot of distorted incentives to go out and buy government bonds, that will also work in the same direction.
Sorry, I want to let you answer this. The experience of Sweden in the early 90s is potentially an interesting case study for your question. Because, I mean, of course, they had their massive crash. For a time, they had interest rates at 500% because capital flight was, I can't remember, 1991, 1992. And since then, they've sort of been a model of, I mean, they've gone up and down and in and out. They've had various administrations, but they have been something of a model of a welfare state living within its means under a fairly, I mean, to call it hard money, it might be going a little far, but at least maybe a more reliable monetary principle. I don't know.
Yeah, I mean, the only thing I was going to respond is looking at, I think politicians, unfortunately, in the short term, are always going to pander to the banks, the way the banks basically run for the shareholders. So bank management just run their banks for shareholders rather than the wider investor base. But I think politicians short term are going to be willing to give up, whatever cuts they have to do to save the banks. Until we have a hard and fast, almost watertight resolution mechanism in place, I think that unfortunately is going to happen. And maybe I'm just being over pessimistic here and just not giving the politicians much credit, but I think that's the way it's going to go. And, that continues to happen in the UK, and it's probably going to be that way for until just before the next election, when they either privatise Lloyds Bank fully or RBS just to get re-elected. But as soon as those politicians are re-elected, then somebody has to pay for that. So unfortunately, I think short term that'll continue to be the case. But hopefully I'm proved wrong. But I just get that feeling.
Yeah, I have a question a long time ago. The Dodd-Frank Act, that was actually meant as a revival of the Glass-Steagall Act. And first I was pro it, but I did read that most of the companies are just using derivatives to finance the production of their product, and from the beginning to the end. And the second objection that was published in Cato, I don't know whether you know that think tank, and they said these people are judge, legislator and executive in one. And I think that is most offensive and worst part, because you really have to separate all those three. So my question is, what is either of you, your opinion about that?
I mean, I'm generally against how far Dodd-Frank has gone in terms of the prescriptive nature of it.
Yeah.
People highlight Volcker rule part of it, but I think that's just one part of it. And that by itself is not necessarily a bad thing in terms of taking some of the proprietary trading away from banks, or at least pushing it to the shadow banks, because that is potentially what might bring them down. But I'm generally against that level of prescriptive regulation. I think that's just gone too far in terms of the way it was managed as well. And when you see it, when a failure does happen in the US, the way that failure is going to be resolved in terms of the FDIC coming in and sort of single point of entry, top down, forcing losses on bondholders and shareholders in a holding company. I think that's the way that globally that's going to go, but I don't necessarily agree with that either. I think Dodd-Frank is too prescriptive. I think the way it's run is just too prescriptive. I think there are too many agencies involved in the US as well. So I agree. I mean, I'm not wholly anti-regulation, but I think that is too far.
Yeah, but would the banks be better off when the natural rate would handle it? Because now it's artificial low level, and the banks don't know how to move or to finance their products. That is one of the things that exactly for me is always said. That this already in his time he was talking against the artificial low rate level of rate. Yeah. So you were talking about that in the beginning.
I mean, I would mention that yes, the artificially low rates create this boom in various carry trades, which of course the banks exploit and can still exploit, I think, under Frank and yet the capital markets in this environment don't do a good job of disciplining the banks from pursuing those carry trades. But I would also mention, without knowing much of the details of Dodd-Frank, that what I do understand about some of the intricate individual regulations is they seem to give banks a complete pass on holding of government bonds. So government bonds are a sort of privileged asset class. What sense does that make? Which comes back to a more general point of this implicit deal that's done between the banking systems and the financing of government debt. And putting that into a European context, I mentioned Spain and Italy, where essentially the banking systems in those two countries are being drawn into a more and more questionable financing of weak sovereigns. Who's ultimately going to pay the price here? At one extreme, it can be the financially relatively strong countries in Europe who eventually will have to somehow bail the whole system out. Or ultimately, it's going to be a bail-in through inflation. So in an ultimate scenario, if Italy or Spain leave European Monetary Union, you have high inflation and the depositors essentially bail in through inflation. Which is one form of bail-in. I mean, I think, all this discussion of bail-ins or not bail-ins, historically the biggest form of bail-in has come through unanticipated inflation.
But how is this that suddenly we are afraid of deflation? I mean, the prices are going down and so on, and then of course Japan is coming in this whole picture. I think that you made a mention deflation somewhere.
Deflation, and this is very much the Austrian topic, I think.
Yeah.
And deflation phobia,
We are not afraid of
deflation, monetary deflation, happens when there's a relative shortage of money.
Yeah.
You can't identify monetary deflation by just saying a few prices have fallen. A few prices falling does not indicate monetary deflation. In a world where, if you go back to the gold standard world before 1931 and 1914, the norm over many decades was price stability. But to have price stability, you have to have some periods when the price level is falling and some periods when the price level is rising. And the periods when the price level would fall would be ones where you had exceptional growth in productivity. High productivity growth would mean prices falling for some time. Nothing sinister about that, and it's not monetary deflation. And I think if of course in terms of business cycles, deflation played an absolutely crucial role in relaunching the economy into a recovery phase, because what typically happened during a business cycle under the gold standard would be that prices would fall during the recession. Everyone anticipated price level stability in the long run, so the expectation would be that prices would rise again in recovery. So you've got your negative real interest rates through the normal pro-cyclical behavior of prices. You didn't need Bernanke feeding in inflation expectations or Draghi or anyone else. You had your negative real rates stabilizing the system through pro-cyclical movement at the price level. And I find it more and more bizarre that in this age of information technology, we still go around with this sort of chivalry that we must do everything to avoid deflation. It's too complicated for people to deal with, and money illusion and everything else. But if you can deal with wristwatches and smartphones and everything else, why can't people get the idea that sometimes prices fall? It's a price system, and if you try to defy that innate row of prices moving down during a recession, not during a recovery, you create all these sequences of asset price inflation which are much more destructive, such as what's happening at the present. And just moving that discussion to Europe, where is the deflation in Europe? I mean, Germany, which is the core of the European Monetary Union, virtually at full employment, inflation running at about 1% per annum. If anything, there's a lot of asset price inflation you're seeing in the German real estate market. Why on earth, where in sight is monetary deflation? Yes, there may be some downward pressure on wages and prices in some of the periphery zone countries, but they went up too much, way above equilibrium levels during the boom and bubble. So they have to correct down. But to argue that the core country should accept asset price inflation and monetary disequilibrium because it's too difficult to dial back prices that rose too much in the periphery makes no sense at all. Now there is an added argument here that if you actually dial prices back, then maybe there's going to be some debt defaults in Spain and Italy. But of course there should be debt defaults in Spain and Italy. The debt rose too high relative to the real underlying income earning potential of those countries. And to try to correct excess debt issuance by inducing monetary inflation and asset price inflation is a highly destructive recipe.
I have a question. We spoke about the equity and bonds, but we didn't speak about derivatives like CDS and so on. I would like to know what's your opinion. It disturbed the economy. Apparently it's $1 trillion of derivatives that is around the economy. So I would like to have your opinion on this.
I mean, from an investor's point of view, CDS in its purest form we think is a good thing in terms of it's the most liquid way of taking a position. So a lot of the stuff that we're looking at, particularly banks, we're looking at bank bonds, we can't invest because there's no liquidity in a lot of these bonds. So the way we can do it is in CDS, in derivatives. In its purest form, it is a form of insurance as well. So we can take positions on that. I think a lot of the problem probably came from sort of bank to bank sort of derivatives. So a lot of, one of the good parts of regulation is pushing a lot of these markets onto exchanges. So I think that is probably a positive development. But CDS in itself, I would say, is a positive development for the market.
Because you can buy a CDS even if you don't need this insurance, just that you want to bet on.
Yeah, so you can take a position.
Apparently, from what I've read, it was forbidden in the 1920 in the United States. It was a bucket shop, so it was forbidden to bet on something from which you didn't really get the asset. And apparently, in 2000 it was there is a Commodity Future Act that has been approved and that make the CDS available and everything you could bet on commodity on something without really owning the commodity. So in an ethical point of view, I see no problem to have a CDS if you have a bond on a country, for instance. But if you don't have the bond to the country, why would you buy a CDS?
Yeah, I think you need, for a CDS contract, you need the underlying physical bond. So they're kind of matched. So when if it ever came to it, you'd have to deliver the bond. But so, you know, as long as you have that in place, then CDS provides more liquidity to be able to take some of these positions.
Okay. I don't know, I think you could buy it without owing the...
Oh no, you can, but if it ever comes to the point where you have to actually use the CDS, the insurance, there has to be a physical bond to be delivered.
Okay.
I mean, there are instances, I mean, you can do derivatives on indices, but again, even there, you have to deliver a bucket of that index.
Yeah, because apparently, tell me if I'm wrong, but apparently there are a lot of people that are playing on derivative, and there is $1 trillion that is there, and do not enter in the economy. So, tell me if I'm wrong, but so there is Bernstein, or now it's not Bernstein anymore, that bring money, and that money just don't go to the economy, just go there on all the derivatives, so they play there. Is that correct?
I'm not sure I understand the question, but I think what you're asking is...
Yeah, because apparently, yeah, I mean, since the crisis, trillions of dollars have been printed out by the Federal Reserve.
$300?
Trillions.
Oh, 3 trillion. Sorry.
Yeah, sorry.
Oh, you said 300, and I was like, so
No.
what?
Many. So where is that money?
I think I can answer where the money is. First of all, I would say it's not money printing. I describe it as quasi-money printing. Because what you actually get under the present system, take this $3 trillion, the banks have that $3 trillion lent to the Federal Reserve. And they're collecting 0.25% per annum on those deposits with the Federal Reserve. If they put the money into the markets, into one-week treasury bills, they would get zero. So effectively, under the present system, you've got two sorts of treasury bills. You've got the ordinary treasury bills, which give you pretty much zero, and you've got special treasury bills which banks can buy, which give them a bit more. So the present system is actually a sort of form of subsidized investment for the banks, and it facilitates the Fed's operations of going and buying these huge amounts of government bonds. But it's not as yet money printing in the classical sense. You know, classical money printing in the classical sense is where there's a positive rate of interest in the economy, positive market rates. Money has zero. You force this money into the banks, which is way below the market level. So they then try to get rid of this hot potato as quickly as possible by lending or doing whatever. That's classical money printing. But we're at the earlier stage at present of quasi-money printing. Now that quasi-money printing may one day develop into full money printing when market rates eventually rise. But at this stage, it's quasi-money printing.
Does that answer?
Yes, apparently this money is there, but it's not used really. Into
Well, as you said, it's not sort of capable of being in the real economy right now. It's sort of in this.
Yeah, it's not funding the real assets.
Yeah. So,
Nice cash if you can get it. Were there other questions that I think this question of, just to go back to the question of deflation and why we're scared of it, why it's something that politicians see as they have to avoid at all costs. In terms of, I think a lot of the fear you often hear about deflation is more about sort of the consumer's mindset with deflation expectations. Is that something that is, because if they expect prices to go down, then they're not going to buy anything, and a recession will sort of get stuck. Is that a theory that anyone subscribes to, or is it just sort of, it's sort of conventional wisdom on deflation, but...
I suppose if you go back to sort of Keynes' general theory, the idea was that wage cuts and price falls was sort of destabilizing because you wanted consumer increase to rise in real terms, and this seemed to go the opposite direction. But what's left out of that altogether, of course, is the pro-cyclicality of expectations. That if the wage cuts are seen as temporary in nature in the middle of a recession, and they're also matched by price cuts to a considerable degree, and there's expectations that fees will be reversed into the economy, then you have the opposite of destabilizing, it's actually stabilizing. And I think the other aspect of this inflation phobia seems to be is the myth of what happened in Japan. You know, there's a myth out there that Japan's lost decade has something to do with deflation. Well, I mean, if you just look at the figures, there hasn't been any deflation. The price level in 2014 is about 2% below where it was in 1992. So Japan has actually had virtual price level stability. Moreover, whatever price inflation you have had in Japan has been more than 100% explained by qualitative growth, cheap imports coming in from China. So it's never been real deflation. So it's very hard to argue that deflation was ever a problem in Japan. There's been many other problems in Japan, whether it's financial repression, lack of equity risk appetite, or the lack of structural reform, etc., etc. But deflation has not been the problem.
The question is, can you get different forms of deflation? Some deflation good, some bad. I can imagine as a consumer you might say, well, I don't mind the house prices are deflating, but as long as my wages, I'm okay. I mean, can they exist at the same time, or is that just not?
I mean, if your wage is coming down because you're in a very cyclical industry, that's just normal expectations. And if you work in the auto industry, or you would expect your wages to come down during a recession and go up during a boom. So you come to a recession, your wage goes down. That's normal expectation. I think and if other prices are coming down also for cyclical reasons, then some people will actually be better off at that time anyhow. So can you imagine bad deflation? You know, bad deflation, people very often talk about what happened in 1933 or 1932 and prices go on going down, and because you think they're going down further, you cut back spending. But, you know, 1932 to 1933 is such an extreme situation where, you know, you have to remind yourself in that period, second biggest country in the world, Germany had gone into default. The whole US financial system had become very highly geared on lending to Germany. That had been the biggest carry trade in the 1920s. It wasn't Greece going bust, it was Germany. And I think there's a lot of underestimation of just what that means. Clearly that created huge problems in every way. But that's hardly a sort of normal cycle of price falls and price gains, which is what one would expect if one wasn't meeting that gigantic iceberg, or whatever the metaphor should be.
There was, yes.
Would you say that the European Union are presenting enough support to those countries that have been bailed out as a form of like a follow-through? Because it's great that countries are getting bailed out, we're keeping Europe together, but if countries know that they can potentially be bailed out and carry on using their kind of banking system in a way that's more favourable to them, then how is the European Union kind of supporting what they've actually kind of given that country? As a student, I'm just kind of interested to kind of see.
Well, here you have the problem of perverse incentives. That if there's a bailout there, and all the various programs to support bond prices in the weak countries, does that actually hold back the process of cutting spending in those countries? You know, if they're getting cheap funding, why? What's the need to cut back spending? If the banking system has been implicitly subsidized one way or another and being encouraged to go into financing debt in Spain and Italy, that may get you past the crisis, but it's an ongoing very severe cost because the banking system cannot raise equity capital. People don't want to put equity capital into a system which is basically there in some deal with the government to fund debt, which should have been partly written off by this stage anyway. So you get into a vicious circle where the banking system remains undercapitalised. So the question you have to ask is whether Spain and Italy would have done better to have recognised that some of their debt would never be repaid, had some sort of rescheduling, had some bailing in of their deposits in the banking system, had some of the banks go bust, and gone over to a free competition and non-regulated financial system and cleaned all this mess up, rather than going on down the present road.
So would you say that by reducing kind of regulations increases kind of personal countries' incentives to actually get an increased power back in their financial?
I think that's part of the process, but first you have to have the writing down of debt. You can't talk about freeing up the Italian and Spanish financial systems, allowing free entry into the banking system and everything else, which would be very positive for entrepreneurship and everything else, without first having dealt with the debt.
I mean, the EU basically did rescue Spain through the ESM. I think the way...
Well, they rescued the debt holders.
Yeah. But what I'm saying is, again, in theory, the resolution mechanism, which hopefully they're going to put in place, and the ESM might eventually just be the eventual backstop. But I think before we get there, we do have a resolution mechanism, which is also almost a mutualisation, that it's funded by the banks. And again, that's maybe the sticking point here, is that the French and the Germans and whoever else might never agree on how they fund it. I think you might get to the point where the banks are the insurance or the backstop here. And so you set up a resolution mechanism, resolution fund, which is pre-funded by the banks. And again, that's going to take 8 to 10 years maybe to put in place. And again, you could argue that it might never ever be sufficient. I mean, the 55 billion that people are talking about, I think probably would be for one particular bank, but maybe not systemically for a country. And that's why I think you probably do need a backstop behind it, which might be the ESM or whatever that might morph into in the future. But I think the theory is probably right that you do have a resolution mechanism which is funded by the banks. The banks are on the hook for losses in any particular country. If you do have a banking union and a European union. I mean, you could argue that maybe we don't have a European union, but I think that's where banking union's aiming to go.
Is there any? I had one, but I
There
don't
was
know.
a girl.
Is there another question?
I thought there was another question there.
I know, I don't want to step on anyone's. But this is an interesting, I mean, when you talk about EU support to these countries that have been bailed out, or they bailed out the debt holders, as you say, I mean, these countries, they're still not doing great, are they? They're sort of limping along with their banks, crunching each other. And I'm not telling anyone anything they don't know, and the real issue in Europe that everyone agrees on now, both for the sovereigns and the banks in them, is growth. They need sort of organic, real private sector, unbridled, dynamic, productivity-adding growth. And that's something that, with all the EU's supposed largesse in these bailouts and the before the ESM, the EFSF, and other assistance and support to banks, along with regulatory requirements and emerging regulatory requirements, they've also come with sort of attempts to induce banks to lend in such ways that they do think will be good for growth. For instance, the small and medium-sized businesses. And a lot of times we really see those goals conflicting with the regulation. On the one hand, they're telling banks to hoard their capital. On the other hand, they're begging them to lend to the small tech startup or what have you. So in that sense, there's some tension in the regulations for the broader, crucial problem of growth. And I guess I'm sort of interested in our speaker's views on.
I don't necessarily. I was going to say. I mean, I don't necessarily think that's a bad thing. I think that's disintermediation, and I think that those, and maybe it's a bit of a myth, but I think those corporates and a lot of those corporates don't need the banks to fund growth. I mean, some of it is going to come through cash retained earnings that they've got anyway. A lot of these companies, but there are other avenues to funding growth. I mean, there's trade payables, there's the capital markets. I mean, there's a number of other things that they can do. So I don't think that sort of fixation that particularly politicians have, that banks aren't lending to small corporates, is necessarily a bad thing. I think it just kind of pushes us further towards disintermediation. And again, I think that and is just a logical progression. I mean, that happens in the US much more than it does here.
Yeah.
I think corporates in Europe are much more dependent on the banks than the US, but we're just at a different stage. I think that's the way we're going to move. I mean, the other thing on SME lending, I mean, again, the politicians are bashing the banks, saying that you're not lending enough to SMEs.
It's a big obsession.
Well, but I think a lot of the banks would respond, well, yes, but it's the wrong kind of demand. The companies who are coming to them aren't demanding credit or sort of ongoing lines of credit. What they're demanding is more the stuff that private equity are going to provide. It's startup capital,
Right.
which banks generally aren't in the business of providing anymore.
Risk capital.
So I think it's a very easy thing for the politicians to kind of get the votes by saying, you're not supporting growth, but
Right.
I'm not necessarily sure that it's what banks should be doing. So it's kind of the wrong kind of growth. And again, I don't know, and Brendan will know better than me, I don't necessarily know whether there is a direct link between banks, lending, and economic growth.
Mm-hmm.
And again, I don't know if that's ever been proven, but
That's a good one for them to argue about.
I mean,
Last time I read that George Soros proposed that Germany exit from the Eurozone in order to help the other to solve their problems. What do you think about this proposition?
I don't think any country does anything to help anybody else. If Germany leaves, it would be to help itself. So, and that will depend on what the bill is that they're being asked to pay for everybody else. But I think the one can think of scenarios in the future where that might take place. At present, Germany has been a big beneficiary of global asset price inflation. German export boom to emerging markets, China, Russia, that's all been part of the asset price inflation story. So you have to think if and when asset price inflation turns to deflation, Germany is going to be doing less well, and presumably their appetite for bail-in, bailouts or anything else is going to be shrinking at that stage. So that's where that sort of issue of exit from EMU might become a live possibility. But returning to a question of links between risky lending and the situation of banks, I mean, I guess the argument could be that you've got in an unregulated system, you're going to get lots of different types of banks. So some banks will do venture capital, other banks will be like the post office and just go for a small depositor and have risk-free loan portfolios. And they'll have their business model as to what they're trying to do. But what you can't do is get banks to go lending to venture capital or anything like that if they're constrained and can't get the equity capital, because they're being forced by regulations into business models which couldn't generate the profits to attract that equity capital.
Do you think that's what's happening?
And just that may be something that's happening in Europe today. So, I have this argument sometimes with monetarist friends and colleagues who say, look, in Europe, M3 is shrinking, I don't know, by 2 or 3% per annum, and you're not going to get growth unless M3 picks up. And the only way you're going to get M3 money supply picking up is if you delay the increase in raising equity capital. Well, I think that's putting the whole argument the wrong way around. When you can't force feed M3 by having banks running risks which depend on implicit bailouts from the taxpayer. What you have to do is undo the regulations which are inhibiting all the various distortions which are preventing banks from getting a good rate of return on a viable business model. So you don't press them into buying Spanish or Italian bonds. You don't constrain their business, and you allow them to formulate their own strategy. And then they can raise the equity capital, which would allow the lending to rise.
I wanted to give you a chance to respond from the investor's perspective on the question of Germany taking off from the EMU.
I mean, I'd say it's pretty close to zero, but again, I'd agree. I don't think it's in. Why would if they left? Why would it be in their interest? Unless 100% of their exports go to the rest of the euro area.
Not on the interest of Germany. What he says is that if Germany exits the euro, then the other area will be able to devaluate their money, or the money or the euro, I don't know, and then this will help the other countries, because apparently everything is very difficult because Germany do not really want to have a easy money policy.
Well, so you're saying if Germany left, it would be easier for the rest of the Eurozone to devalue?
Yes.
So why don't they just
Not
leave
me,
themselves?
What's so proposed in an article on CNCS.
It would be easier for them to devalue in part because there'd be less value. I don't know, I mean, that's a very simplistic way of looking at it, but whose interest would that would be in the interest of?
That would be for France, Italy, Spain, everyone, because I don't know, but I'm not a specialist, but what I see is that everyone is devaluating, except Europe. So Japan, the US, China, everyone. So apparently here the idea is if you manage to devaluate, you will boost your export, and then you will be able to benefit from a low value on your currency. Here in Europe, Germany does not really want to devaluate because this will cause some trouble on their saving of the people. So they want to keep a strong euro. So what Soros says is that if Germany exits, it will not be on the eurozone, it will not say anything, and the other country, France, Italy, and Spain, will be able to devaluate the euro and be more competitive on the market.
But that's assuming the whole problem of Spain and Italy is one of relative prices. And secondly, why well, we are to some extent, wages and prices can fall back in those countries under the present system. You don't need a devaluation. But the more basic question is who's saying that the problem of Spanish and Italian economy is just this price level, which can change anyhow. It may be much more to do with crony capitalism, lack of competition, all these other issues, which some forced feed devaluation may just set back doing anything about.
I mean, we have heard throughout the crisis that is the problem, right? That these disparities between Germany and the peripheral economies is really causing a lot of their fundamental or structural problems. I think you and I are both probably quite doubtful of that proposition, but it's a very popular one that's been posited.
I think one of the problems in Europe is that every country would like to have its own policy based on his market. So France would like to have its own policy, and Germany, so there are kind of political fight for who controls the central bank. So I don't know if you agree with this.
I mean, pre-Euro, obviously Spain and Italy devalued, and that was the way that they sort of, got through crises. So I suppose you could apply the same thing. Why doesn't Spain or Italy leave the Euro area? I mean, because if you do have a strong bloc of Germany, the Netherlands, Finland, etc., why do they need to leave? Why not Italy and Spain?
I think, for instance, if Greece would have left the euro, it would have been better for Greece. It would have been able to take back its currency, devaluate, and would not need the bailout of the Troika.
Why would there not have been massive capital flight from Greece, though? Could that not have hurt as much as the austerity measures and the pain they've seen? I don't know. I mean,
so what we see now is that there are now some people that are speaking, saying that what had been done with Greece was bad. So you know that for the moment, Greece is not able to sustain itself. So, and you have a lot of people that suicide also. We should mention that. I don't know, but it's a problem. And so why we didn't actually the former president proposed a referendum to know if people wanted to leave the euro. So I don't remember his name. He was fired more or less by the Troika, and then somebody else came from the banking system just to be sure that Greece will follow the path that the Troika has decided. So I think it would have been better for Greece to leave the the Eurozone and try to solve this problem by devaluating or do anything else. So, I don't know what do you think about that. Do we really have to as Draghi said, do whatever it takes to save the euro?
Well, I'm not answering your question directly, but there's always in all these situations lots of gainers and losers. You know, we're not dealing with a homogeneous population. And when you're talking about, say, helping Greece or helping Spain, very often what one's actually saying is helping the bondholders and helping the depositors. So it's like a Ponzi scheme. You want to help, you give some aid to those who get out first, and it's only a few unfortunates who are left in who lose. But it's not clear that's got anything to do with the longer term economic viability or dynamism of that particular economy being helped in any way at all. And I would just raise another issue relative to your devaluation comment, that if you actually ever did get an economic renaissance in Spain or Italy, in terms of a vibrant dynamism developing entrepreneurship in the private sector, what you would actually see in Spain and Italy would probably be an appreciation of their real exchange rate, because capital would be coming into those countries to exploit the investment opportunities, which typically means a higher real exchange rate, not a lower real exchange rate. So if you actually, in either of these cases, many people look at and analyze this in a sort of static sense and say that you have to reduce the German trade surplus, and Spain has to move from deficit into surplus, and talk sort of some sort of concept of balance and current accounts. But in terms of a dynamic setting, that's completely the opposite of what one wants. If you really want economic renaissance in those southern European countries, you have to envisage a long period of time during which you're going to be importing massive amounts of capital, not through bailout funds, but through private capital coming in because of the real profit opportunities and real entrepreneurship there. And that would actually send their real exchange rates higher.
Okay, but do you think that, for instance, Spain, Italy have the institution, the structure that will allow them to grow even if there is a capital inflow into the country? Because obviously there are countries that are more that are best than other countries. Germany is best, Switzerland is best. If you put money in Switzerland, you are more sure to get money than if you put in Spain or in Italy. So
I think there's a myriad of other reforms that those countries have to put in place. Tax, bureaucracy, protectionism, etc., etc. So I don't think this by itself is going to cure those countries. I think for countries like Spain and Italy, it's going to be a long process. They have to take the medicine and they have to reform. I think my opinion is that Spain's probably a little bit further along the road than Italy, and I think Spain, the Spanish banks are in a much better position than the Italian banks are in terms of realising the potential losses, restructuring. There were losses forced on savers in Spain and bondholders. They were relatively small, but there were losses. I think the Italians, as we'll probably see in the upcoming stress tests, are the ones, or particularly the smaller Italian banks, where there are issues. And there are a lot of restructured loans which need to be repositioned as non-performing and provisioned, and more capital put into those. But I think there are a huge myriad of other things that those countries need to reform, not just banking and not just potential wage structures and what devaluation could cure.
So then I will ask a very simple question, two questions actually.
Last one, and then we're going to give time for.
Do you think they will default? Do you think most of European countries will default on their debt? And do you think that we need to stay on the Eurozone in order to solve this problem? Two simple questions, I think.
Who wants to go first? Who wants to respond?
I'll just say no to the first one.
I think there will be defaults, but the question is whether the default's going to come through explicit bail-ins and write-downs and restructuring, or whether it's going to come through some process of inflation. But one way or another, there will be write-downs.
Yeah, inflation again is sort of the invisible
And
bail.
capital control, and there is a lot of means by the government in order to not pay what they have to pay. And do you think we need to stay on the Eurozone? Do you think it's healthy for people?
Well, I mean, that's a huge question. I don't think it's whether EU's ideally in a world of global monetary stability. If you ever got back to a stable U.S. monetary policy, monetary stability in the United States, I don't think there would have ever been any need, any political any momentum behind the whole European monetary experiment. Because in the world of U.S. monetary stability, everyone would just peg to the dollar and everyone would be over dollar standard. So in a way, this whole movement of European monetary union has been a product of U.S. monetary instability.
Oh, the closing word. Okay. I think we have. Is there any final questions before we go to the final closing words? Okay. Sorry. We're gonna have. Sorry. Yeah, Professor,
I think
please.
we're all very happy with the highly technical speech explanations. So thank you very much to the speakers, Mr. Brown and Mr. Hussey, and thank you for the moderator. Thank you very much. Thank you for having made this conference possible. Mrs. Godart surmounted all the difficulties as usual. Thank you very much. With the help of her assistants, thank you to you three who helped her. And as you know, UBI has started a program in Luxembourg, and so probably next conference will be there. We never know. That might be a change. Next year we don't know what the topic will be. We'll try to have something very exciting for next year again. Thank you very much. See you next year.